finhealth approach to personal finance suggests that a key requirement for the achievement of good financial health is to select an appropriate target growth asset allocation ratio to be achieved by retirement and/or financial independence. That choice of that target is likely to be highly influenced by your attitude to investment risk. A maximum growth asset allocation target, say for example 60%, implies a minimum defensive asset allocation target, that is 40% in this example. Below these high-level asset allocation targets, you'll generally establish sub-asset class targets. For defensive assets, these may be for cash, Australian fixed interest, and/or international fixed interest. The growth asset targets may be for example, Australian shares, international shares, Australian and international listed property. It's then necessary to develop and implement an investment strategy designed to achieve and/or maintain these targets. In our view, it's certainly not a case of set and forget. The rest of this video examines the importance of regularly reviewing and responding to changes in both your high-level and sub-asset class allocations, that is, portfolio rebalancing. Otherwise, you may find yourself taking unintended investment risks that may be considerably higher or lower than your well-considered targets. Hi there, I'm John Lesky, recently retired personal financial advisor and founder of finhealth, a tool to guide you to your financial independence. To help with this discussion, I'll assume that a 50% defensive, 50% growth target has been chosen for a retiree. That is, there is no future capital included as a component of defensive assets. The chosen sub-asset class targets, consistent with the high-level target, are shown in the table on the screen. To at least approximately maintain this allocation, the retiree should ideally have a predetermined portfolio rebalancing strategy. Two popular approaches are: 1. To implement adjustments if the high-level asset classes and sub-asset classes deviate from targets by more than acceptable amounts. For example, 2.5% for the high-level asset classes and 1.5% for the sub-asset classes. And 2. To review and adjust the portfolio back toward the targets at regular time intervals. For example, 1, 3 or 6 monthly. The first approach is more hands-on and requires constant monitoring of the portfolio. The second only requires you to review at the specified times, but may result in your portfolio deviating significantly from target if there are large market moves between reviews. The chart now shown on the screen shows the growth of the 50-50 portfolio discussed above for the 30-year period from 30 June 1991 to 30 June 2021, based on an initial balance of $1,000. Well-accepted sub-asset class indices are used for asset class returns. For purpose of the discussion, annual rebalancing to the targets is assumed. In practice, more frequent rebalancing is probably desirable. The next chart shows both the growth of the rebalanced portfolio and the initial portfolio, but assuming no rebalancing. As it turns out, the trajectories and end values look very similar, but underlying the no rebalanced portfolio is greater variability in returns and a significant increase in investment risk, as the allocation to growth assets increases progressively over time. With regard to variability of returns, as measured by a statistic called standard deviation, the no rebalanced portfolio was almost 18% more variable. And the chart now shown, comparing the constant 50% growth allocation for the rebalanced portfolio with the growth allocation resulting from no rebalancing, reveals the increased investment risk of the portfolio over the 30 years. With no rebalancing, the portfolio's growth asset risk is all over the place, subject to the whims of market returns. The final year growth asset allocation of 67.5% is well above the target growth asset allocation of 50%, exposing the retiree to greater investment value fluctuations than is likely to be comfortable. Next, the chart on the screen reveals how the composition of the sub-asset class allocations changes from June 1991 to June 2021 with no rebalancing. The allocation to cash falls dramatically, while Australian shares account for almost 34% of the portfolio in 2021, compared with the initial target of 21%. Investment risk management is non-existent. There are other potential benefits to both rebalancing and diversifying broadly. Rebalancing requires you to reduce your holdings of the asset and sub-asset classes that perform relatively well between review periods and increase holdings that perform relatively poorly. It mechanically forces you to sell high and buy low, rather than let the asset and sub-asset classes that have performed relatively well inadvertently become larger components of your portfolio. In the example we've been discussing, just because Australian shares outperform international shares for the time period examined doesn't mean that they will continue to do so. And, as already discussed, a below target allocation to lower expected return defensive assets exposes the investor to greater fluctuations in portfolio values than their attitude to risk suggests they could cope with. And the sell high, buy low discipline, implicit in rebalancing, offers potential to enhance returns compared with the weighted average of the individual sub-asset classes. For our example, the weighted returns of the 50% defensive, 50% growth portfolio were 7.6% a year. It assumes that the target allocations are constantly maintained. However, the return of the annually rebalanced portfolio was 8% a year, that is, 0.4% a year higher. This reflects that for our example, letting the allocations move a little from target and periodically rebalancing slightly enhance the portfolio return. The benefit of diversification is revealed by comparing the weighted average volatilities of the individual sub-asset classes of 9.2% per annum with the annually rebalanced 50-50 portfolio of 6.2%, that is, an almost 30% reduction in return variability. This reduction reflects the fact that the returns of the sub-asset classes don't move exactly in tandem with each other, so large rises or falls in one sub-asset class may occur while another is reasonably constant or may move in the opposite direction. Disciplined portfolio rebalancing to predetermined targets ensures that your investment risk never inadvertently strays too far from that which you are comfortable with. It's, ideally, a mechanical approach that will override any emotional tendency to allow outperforming asset classes to become larger than target components of your portfolio. When things are going well, investment risk perceptions often diverge from your more fundamental, stable attitude to investment risk and may lead to an excessive investment risk taking. Combined with broad asset and sub-asset class diversification, a well-implemented rebalancing strategy ensures efficient and effective investment risk management. It gives the investor a high chance of achieving the highest expected pre-tax investment return for the level of risk they can tolerate. Once your investment portfolio is set up consistent with this approach, there is next to no tinkering with the portfolio required, other than the usually occasional rebalance. It's boring, but it's effective. Hopefully, you found this video of interest. I'd like to know what you think. Please provide any comments or questions below. Finally, thanks for watching.